Welcome to Open House, the real estate and mortgage show on News Talk 580 CFRA.
If you have any questions about mortgages or real estate, give us a call at 521-TALK. That's 521-8255 or text 580-580. With Frank Napolitano and Paul Rushforth, here is Steve Gregory.
No, Paul is still celebrating his birthday. Month 4.
Man, he better be buying breakfast when he gets back. But thank you, Steve or Greg. Who bought? Steve did?
Yeah.
Wow.
No, don't tell him that. He's going to have a heart attack right here on the show.
Wow. Paul, if you're listening, Steve bought breakfast.
Jonathan Hull is in for Paul. How are you, Jonathan?
Good, guys. Thanks for having me.
Thanks for being here.
Not a problem
I
at
thought
all.
you were going to visit us last week, but then you bailed at the last minute. You must be way busy.
Work, yes, yeah. I've stayed busy. It's the spring season, right? So you got to make hay when the sun shines.
How long have you been with Paul now?
Been with Paul for I think it'll be coming up on 2 years here.
I thought you were going to say too long.
No, I wouldn't say that. He might be listening. Right? No, yeah, coming up on 2 years, and it's been great, fantastic. I've really enjoyed it.
Now, I read your bio. It says you were a competitive hockey player.
Yeah, I was. I was actually a goalie. So.
Oh, really?
Wow.
As competitive as you can be being a goalie.
Well, there goes my next question. I was going to say who was better, you or Paul, but if you were a goalie.
There's no comparison. I was better.
All right, big week, huge week. We got all the May numbers, and we got the one number we were waiting for.
About time we get to celebrate a little bit, eh?
Ooh, even though it's just a quarter point, at least it's something.
It's the beginning. And actually he left an opening to cut it already in July. He really... Normally, he's very reserved in his speech, but this time he really opened the door to potentially another 0.25% cut in July, on July 24th. And, just 3 days later, the job report comes out and our unemployment's up. We lost a lot of full-time jobs. We gained some part-time jobs, but the question always being is they don't specify what these part-time jobs are, but certainly in the U.S., they're pretty open about the fact that a lot of the jobs that are being created in the U.S. are people taking on second jobs because they're trying to make ends meet. So I suspect similar might be here.
If we lost over 30,000 full-time jobs, you got to get money from somewhere, right?
100%. So you'll take on any job you can, at least to replace it. But
so that'll be good news for a next rate cut.
It'll be good for July 24th. Again, we've got an inflation report coming out soon, I think in 2 weeks or so, and then we'll have another job report actually before the Bank of Canada makes their next decision. So it's expected that right now the betting is on another 0.25% rate drop on July 24th, which is great news. But again, it's just the beginning. It's not. This isn't. I don't believe that, and I've been saying for a while. Once it starts, it's going to continue. It's just we needed to get that first one out of the way. And it was nice to get it done this month because there was some talk that he might have waited until July for the first one.
2 or 3 more, you figure, by the end of the year?
3 more by the end of the year. I figure that there's July. He may pause in September, but then resume again for the last 2 of the year. So.
But these numbers we're getting are, 6 months old, more or less?
What do you mean? The CPI numbers?
No, the numbers that we're getting that they're basing all of this on.
No,
there's a lag, right?
There's a little bit of a lag, but it's a month or two. It's not. Yeah, it's a month or two. So you feel it. I mean, I think Canadians have been feeling this for a while, that they're struggling. And again, there's a large number of mortgages. The biggest concern that everybody has right now is the number of Canadians that have their mortgages coming up for renewal over the next 2 years, and whether they can remain in their homes and whether they can sustain the higher interest rates and the higher payments that come with it.
Yeah, but it's no bargain. You don't have much choice now.
Well, right now you don't have a choice, but if your mortgage comes up in May or June or July of next year, that's the critical. So more. No, mortgages,
I mean what I'm saying is you don't have much choice in mortgages because the 1, 2, and 3 year are through the roof.
Too high. Yeah, we'll start to see those start to come down as prime rate comes down. We'll start to see the short-term rates come down before the long-term rates do. So we'll start to see the 1, 2, and 3 year mortgage rates come down. The 4 or 5 will come down, but not as quickly as the 1, 2, and 3. So that eventually we'll get back to what normal is. And normal is a 1 year rate. If a 1 year rate's at 4%, a 5 year rate's at 5%. Normally it's 1 point between the 1 year and the 5 year, not the other way around, where right now we've got the 5 year at 5%, and really the 1 year is at 6.5%, 7%. It's not even 1 percentage point, it's a point and a half.
Cheaper to go variable.
Way better to go variable. By far now, the most action we're seeing, clients are open to taking a variable, or let's call it an adjustable rate mortgage. So now for anyone that's looking to get a mortgage, if you bank with TD RBC and CIBC, they have variable rate mortgages. Most of the other ones have adjustable rate mortgages.
What's the difference?
When interest rates are coming down, if you're looking for your payment to follow the interest rates, you want an adjustable rate mortgage. So on an adjustable rate mortgage, as prime rate comes down, your payment will come down. If you take a variable rate mortgage, you've got a fixed payment, but the interest rate comes down. So again, if you're comfortable with that fixed payment and want to pay off your mortgage sooner, a variable is okay. But if you're taking the adjustable rate mortgage because you're waiting for rates to come down and you want to then be able to take advantage of the lower payments as well, that's when you would go for the adjustable, because as prime rate comes down, you'll get a letter in the mail or an email saying prime rate is now 6.95. You've got prime minus 1, 5.95. Your new payment is now X amount, which is lower by the 0.25%.
And are they going to continue with this fixed payment, considering what we've been through?
I think that's the number one target on OSFI's range right now. I think in December when they make new announcements, I suspect that they're going to make a recommendation to all the banks that do the variable rate mortgages to discontinue them and change to adjustable rate mortgages so that we don't get into the scenario like we did over the last 2 years where some Canadians are in 40, 50, 60, 70-year amortizations because their payments remained flat as interest rates went up. And they ended up, their mortgage amount actually started to go up instead of come down. So,
but what happens to these people when they renew now?
Well, so this is where OSFI's made some recommendations, and I think the government is going to go with them because they have no choice. Otherwise, we'll have a housing crisis. But right now, they've approved up to 35-year amortization, but I suspect they're going to give a green light to some of the banks to be able to help Canadians so that if they come in and 35 years is still beyond their reach, they'll allow them to go a little bit longer.
Like 40?
Maybe 40, 45, who knows? Like they'll, I would say
You're not moving anytime soon if you've got that.
Well, you're not going anywhere. Well, you could sell the house, I guess, if you wanted to, if you can't afford it.
Who would you call for that?
Who would you call for? Well, I'm thinking Greg or Jonathan, maybe. Jonathan, probably. Great radio voice, by the way.
Hey, thanks,
Jonathan.
guys.
Yeah, no kidding. I'm leaving. I'm out of here.
Yeah, I got the face for radio. He's got the face for TV, actually. So.
I'll stop, guys.
Yeah.
Let's see if we get him blushing a little bit. Are you seeing attitudes change? I know it's early. It's only been a few days, but
Yeah, I would say I haven't. Yeah, it's still early. However, it instills some confidence in the market. That quarter point, everybody was kind of sitting on their hands a little bit, especially for the last couple of months. We've noticed an influx of listings and the buyers just really sitting on their hands. With that quarter point and with the expectation that another quarter point is going to come down, I think we're going to start to see a little bit more movement, especially throughout the summer, which is obviously our busiest time here in Ottawa as well.
are you going to? You think it'll be more tire kickers? At least people wanting to get back in and see what's available right now, and maybe not ready to pull the trigger. But
Yes, I do. Like I said, the quarter point doesn't mean that it doesn't increases people's buying power as much as they'd want it to. So yeah, there's going to be some tire kickers. What we've really noticed over the last little bit is it's been really difficult for the first-time home buyers. It's hard for them to get in the door. We've seen a lot of secondary and tertiary moves where people have some equity that's been built up in their home, and they're able to transfer that over into their next purchase. But the first-time home buyers, it's been a struggle for the last year, definitely.
yeah, they've been waiting and waiting. And
They have
waiting.
been. They certainly have been
And they'll
waiting.
continue to. Like, honestly, I feel like our spring market hasn't been our typical spring market. I think that's going to happen in the fall, but only because there'll be another rate decrease and potentially even a third one maybe in September, although I think he'll wait till October. But, if there's that third one in September, first-time home buyers now all of a sudden a 0.75 of a point drop if fixed rates, the bond market follows. The problem with the bond market is that it's more reliant on everything else. So an example is it plunged. Like on Tuesday, it plunged. Tuesday, Wednesday, the days of the bank leading it to Bank of Canada, it plunged. Yesterday, the Canadian job report comes out, and it plunges a little bit. Then the American report comes out, and right up it goes because the Americans created so many jobs that the bond market went back up. The reason that's relevant is because bond markets are what determine what fixed rates do. So, where we expected maybe fixed rates to come down a little bit next week, now all of a sudden it's at best 50-50 just because the bond market drove up because of the U.S. jobs. So, but I think first-time home buyers are on the fence, and you're right. Mm-hmm. They're going to stay there for a little bit. They need 3 or 4 prime rate drops and fixed rates to get into the low 4s, high 3s. That's when all of a sudden your qualifying now becomes at 5 or 6 as opposed to 7 or 8%.
Well, that's the problem. It's qualifying for first-time homebuyers. If they want a variable right now, it's still...
Buying power is just not there.
What do you
And you're right. A quarter point did nothing.
No.
Did absolutely nothing, a quarter point.
No,
but it gave hope.
It might peak
It
interest.
did. It gave hope. Exactly.
Gave
It gave hope. Gave hope to the market, which is it's a step in the right direction.
First-time home buyers, especially the young Canadians, are saying, well, and I say to them, listen, just because now's not the time, it doesn't mean it's never. Save your money, try to pay off as much unsecured debt as possible, keep your credit clean, and hopefully you'll get a couple of raises in your jobs, and therefore, as the interest rates come down, your qualifying will be there because your buying power will be there at that point.
521-TALK, 521-8255. We will be right back. Welcome back. Jonathan Hull in for Paul Rushforth. Frank Napolitano is here. Greg is here, too. Greg was our big guest last week. You did an amazing job.
Oh, thanks, guys. It was fun. It was fun being in the big chair instead of sitting across, having to look at Steve all day.
Yeah, you're right. I mean, that was the benefit. Now you got to look at Steve.
Don't blame
Straight
you.
ahead of you.
How's Greg to work with, Jonathan?
He's fantastic. Absolutely fantastic.
Nice to walk
professional.
in.
He's complete professional.
I know it's going to be done right.
Yep. He's excellent. He's excellent. Best photographer I've worked with, bar none.
It's your first one, eh?
No, come on. I've worked with some bad ones.
You know what? I haven't seen one reflection of his body in a bathroom mirror.
Oh, no.
In all of the pictures that he's taken.
Never will. Never will. That's some Photoshop skills right there.
You're still using drones?
Yeah, for now.
Depending on the houses, or
why are regs changing?
Well, there's some talk about the U.S. government banning the DJI drones, that's the main kind of commercial drone that most people use. Even RCMP military are using DJI drones. So, U.S. government is talking about banning them because they're made in China, and a lot of the data and stuff goes through servers in China. So they're not super happy about that.
Well, I got an idea. Make them in the U.S.
Yeah.
Oh.
All right, let's make them in North America.
Get a better idea.
Manufacturing onshore?
Get a better idea. Make them in Canada.
Yeah. Jeez. I don't get it. I just don't. A big country like the U.S. that relies too much on everything coming from other countries, they need to do a better job of keeping it in-house and being able to produce their own stuff. And yes, labor's a little more costly, but I don't know. I think the security is worth it. The safety is worth it.
No,
Wow.
agreed.
This is Donald Napolitano.
No, don't put Donald. Don't put me in Donald.
We'll get to the numbers from May, but first let's go to the phone. Take a call from Jacques. Hello, Jacques.
How are you doing?
We're doing great.
Bonjour, Jacques.
I have a question on principal residence and capital gains. I bought a cottage in 1981, paid $20,000. And then in 2014, my parents passed away, and I inherited the house. And then if I wish to sell my cottage now, let's say at $550, what will be the capital gains? And can I claim my principal residence from 1981 to 2000?
No, but do you have a house you live in that's yours, that you're owning right now, that you've lived in since 81, or have you been renting?
Since 2000. Well, I've been living here since 1963.
But do you own the house, though?
No.
Right.
I didn't own the house at the time I bought my cottage in 1981.
Yeah, but did you buy the cottage, or did your parents buy the cottage?
I did.
You bought the cottage.
Yes.
So was that your principal residence? Was the cottage your principal residence?
Well, I want to claim it between 81 and 2014.
And what happened in 2014 that changed?
I inherited the house from my parents.
Oh, the house, not the cottage.
Not the cottage.
Not the cottage.
So
So, now
whatever-
your
so-
house is now your principal residence since 2014.
So whatever the cottage has gone up from 2014 to
Did you get an
now is
appraisal?
what you have to pay
Yeah, you'd
capital
have to have
gains on.
an
Yeah.
appraisal would have had to have been done.
Yeah, you didn't get an appraisal in 2014, eh?
Yes, I did.
Oh, good. Well, then the capital gains is based on the value between 2014 and 2024. I mean, best to check with an accountant, obviously a tax accountant, but I would I would think that based on the information you gave us, if you lived in there until 2014, it was capital gains free.
Mm-hmm.
The minute you moved into the house that you inherited from your parents in 2014, so from 2014 to 2024, that's where the capital gains incurs.
And when does it go up, Frank? Is it the end of
It's,
July?
June 25th, and they're passing it through this week, so it's not changing. It doesn't sound like it's changing.
I had it appraised in 2014.
What was it worth then? What was it worth then?
$255.
And what do you think if you sell it now, it's worth?
$550.
$550? Well, it's going to cost you some capital gains.
Yes. What about the new capital gains dated, coming into effect June the 25th?
Unless your sale of your cottage happens June 24th or sooner, you're going to be subject to the higher capital gains.
Which is what, anything over 250?
Anything over 250.
Yeah, 250, yeah. So you're close.
So
you're not
I'm
that far
close.
off,
Well,
but anyway. Your capital gains won't
maybe-
be too much. Talk to a tax accountant, but your capital gains won't be that much.
Okay, can I add a third question?
Sure.
Real quick, sure.
If I sell my principal residence right now, will I be taxed since I inherited the house in 2014?
No, it's your principal residence. It would have been taxed at the time of 2014. And since then, you've lived in the house, so it's your principal residence. You should incur no taxes. But again, check with the tax accountant just to be sure.
But you're on the deed, right?
Yep.
Yes, I am.
Okay.
Yes. Okay. Well,
Okay.
Thank you very much.
Thank you,
I
Jacques.
see, Jacques.
Wow, we're so smart, huh?
I don't know about that.
Yeah.
A tax accountant may have a different. So if the next call is a tax accountant, we know we said, or I said, not we, I said something wrong. So
But the important point is, if you ever inherit anything or you change your situation,
Get an appraisal.
Get an appraisal.
Get an appraisal.
Right away.
Always get an appraisal, yeah, for sure.
Because
Yeah.
otherwise, you can't say, well, these were selling for this.
Nope,
much
you
then.
cannot. You've got to have an appraisal done.
if not, you're opening the door to CRA to
That's right.
decide what the value is, and who knows where they're going to get that value. But you're subject to it unless you have something to back you up. So always get an appraisal. If you buy a new house and you keep your existing one as an investment property, get it appraised. Like the minute that you move out, get it appraised so that you know what the value is while it was exempt for capital gains.
Including if you inherit a place, right?
Same thing,
Yeah.
because at inheritance, that's when the clock starts running.
Exactly,
So
yeah.
you want to be able to have that appraisal to back you up. And keep it. Don't throw it away. Keep it.
The other thing you have to make sure of these days is the vacant unit tax. Make sure it's paid.
Make sure that you log into the City of Ottawa website.
If you're buying a
check that
house,
off.
make sure you double check that
Yes.
it's paid. People are running into this now where
Really?
it hasn't been paid, so they're getting hooped and they're getting bills of over $3,000 or $4,000.
Wouldn't a lawyer? We should have a real estate lawyer. Like wouldn't they make the change at that point so that it's unvacant?
Well, what happens is if it's early in the year, then the person hasn't had a chance to file yet, so it
Right.
goes missing. And if it goes missing,
they don't care because they're not going to own the house anymore.
Exactly. But if it goes missing, then you're on the hook.
But I'd like to
It's
think
not
the
the
city
homeowner.
will make an exception there and say, okay, like the house changed hands and
So I had a client who it just slipped their mind because it's a new thing that's just come into effect, and she got billed just what you guys were saying, around $3,600. It was a pain. It was a pain for her to go through the city. She did end up getting it reversed, but it was a complete pain for something that takes 5 minutes to do on the City of Ottawa website. It caused her a lot of grief, but she did end up getting it reversed. But it's not something that I'd recommend doing.
But if you buy a house and all of a sudden the other owner is gone and you get this bill, it's up to you to
Yes.
pay it. It stays
Yeah.
with the house. It doesn't go with the previous owner
100%.
unless you get a deal signed
Yeah.
when you're buying the house.
Yeah, 100%. That's why I'm surprised it's not a lawyer thing at the time that there's a change of deed and title, that the lawyer doesn't notify the city that now it's going to be owner occupied and here's the new person that's moving in there. And that's the way it should
Yeah, but
be.
it doesn't matter because if they haven't paid and you're buying the house, you're on the hook for it, not the seller.
Well, no, but at the change of title, the property taxes are brought up to date at that time. So I don't know that.
No, but it depends when, right?
Yeah, but they're still brought up to date. Oh, you mean if they haven't been taxed yet?
They haven't
Yeah,
been
if
taxed
they haven't-
yet.
Yeah, if they haven't been taxed
And
yet.
that tax bill comes in
Yes.
after you are the new owner.
Yeah.
You're on the hook for it.
Yeah, I think there's got to be a fix to that. There's got to be something to protect the purchaser from being stuck in a scenario where it has nothing to do with them, what happens.
City
So-
made $11.5 million on this vacant unit tax.
It's
last
crazy.
year. $11.5 million.
It's crazy.
They figured they'd get about 6. They got 11.5.
Wow.
And
Yeah.
I think there were 6,000 or so, and 2,000 of them were overturned.
Yeah. So any chance of that being discontinued, out the window.
No,
not with
not
that
with
much
that kind-
revenue.
no,
not with that much revenue.
Once the
Just like
money's-
those safety cameras that are out there.
Oh.
You know, they really slow drivers down.
You know,
they
my-
really keep neighborhoods safe.
The voice on my GPS is losing its voice
Yeah, I know.
because every
All the
bloody
speed cameras.
intersection I go through, it's either a speed camera
Yeah,
or it's
or
a
red
red light
light.
camera. And I'm going, well, at least I have somebody to talk to, but, you know.
You got a friend in the car.
521-TALK, 521-8255. We'll be right back. Welcome back. Let's go straight to the phone. Say hello to Adam. Hello, Adam.
Hey, how are you?
We're great.
I have a situation. I think it's an opportunity. My sister rents a home in Pickering, and she's been renting for 10 years, and she's at a very low rent rate. And now she's gotten notice that they're selling the house, and they're giving her first dibs in a private sale. They're listing the house with her at $950. She's 5 minutes from the water. And we've had a couple realtors come in to take a look at it, and they're all saying with renovations, maybe 30,000 renovations, we'd be selling this house for 1.25, 1.27, 1.2, right? So it just seems like we'd be silly not to.
Selling your house now for 1.2?
No, selling the house.
No, selling the house that she would get for $950.
Yeah.
$950.
Yeah.
Yeah. So, like, my sister can't do this alone. She doesn't have the money for a down payment. I would be basically giving the capital for the down payment, 20%. And I wouldn't be on the title because as much as I own my home, I'm between jobs, so I don't have the income that the bank is looking for to get approved, essentially.
Can she qualify for it, though, with her income?
We've been talking to a mortgage broker, and we can qualify, and it's a bit of a mess. It's a three-headed monster between my mother, my sister, and her partner, too, and they can qualify. And then between myself and my mom, we'd be putting up the capital for the down payment.
Okay.
My question, I guess, I just started tuning in, and I heard you talking about capital gains, and that's on my mind. So the realtor I was talking to yesterday, they told me we could be exempt from capital gains. I thought it was like a 12-month minimum that you had to be the property primary residence.
Yeah, there's a flipping rule out there. There's a flipping law out there right now.
Right. So they were saying, though, and again, like maybe this is one of those skirting the lines sort of situations, but the realtor was saying people buy houses all the time, and then after 4 months they realize they can't stand their neighbors, and so then they sell the house, and then they're exempt from a capital gains tax because it was their primary residence. So I'm just curious to your take on that, because that was complete news to me, and just any thoughts you have on just this opportunity, which it sort of feels like it'd be.
There's a risk. The risk is that CRA may say, I don't think so. You flipped it. You're going to pay tax on it. So that's the risk you take. I mean, you can say you don't like your neighbor or whatever, but
there's no steadfast rule of 12 months.
There is. The flipping law says you got to be in the property for 12 months. Otherwise, they consider you doing it as a business, and therefore you got to pay tax on it. That's the way the rule is written.
Even if you have no history of doing it?
Even if you have no history. Are there gray areas? Of course there are, right? A crappy neighbor, whatever, you got in there and you can't afford it anymore. I would recommend, though, when it comes to capital gains, if your mom is in on it, and if the broker is not working with a major bank, because major banks want cosigners, but other lenders are okay with your mom possibly being on as a guarantor. The reason going on as a guarantor is because then she's not on title and she's not going to be subject to capital gains unless she's living in that property too, along with your sister and her partner. But
she needs to show income, right?
Yeah. But with guarantor, the guarantor program allows us to use the income of the person, the guarantor, but they don't go on title. So therefore, that avoids capital gains. If she has to go on title, I would strongly recommend making her a 1% owner, and your sister. And now, again, if you guys are putting up most of the money, you can have a separate contract on the side, which is basically it's a personal loan that you're giving your sister and the partner. Same with your mom, so that when the house is sold, you guys get the money back. So you've got a signed contract in place. But as far as title is concerned, you definitely want to make sure that you try to avoid either you or your mom going on title for more than the 1%, because then you are subject to capital gains. But since they're living in the property, they may have to live in it for 12 months to be safe, and then sell it at that point where they avoid it, or they could take a chance selling it before the 12 months, but then you risk CRA denying the fact that you didn't do it for flipping purposes.
Right. I think the idea is that we would look to move on from it as quickly as possible. So then
the risk you're going to take is you may have to pay capital gains on it. That's all.
Yeah, understood.
Right.
So you're saying 1% own? I didn't.
Yeah, 1% owner. So if your mom has to go on the mortgage instead of guarantor as a cosigner, then when you get the lawyer to prepare the documentation as far as ownership of the property, where your mom is just a 1% owner and your sister and her partner are the other 99% owners.
and then there's a side contract between us that.
Well, if you're giving a gift, right, and you got to code it as a gift, right, a non-repayable gift, the lenders only accept non-repayable gifts from immediate family members. So you got to code it as a non-repayable gift as far as the lender is concerned, but on the side, you got to do a contract between you and your sister and her partner to describe exactly how much you're giving and what you expect to get back at the time of the sale.
And if you don't like your sister, charge her interest.
Yeah.
Well, I'm sure you guys are going to partake in the profit. If this is for flipping, the only thing I'd say is you might want to wait the 12 months.
Yeah, I'd say wait the 12 months.
Yeah, I don't know that I'd take a chance. If I was in your shoes, I may not take the chance. Listen, if you're making $200,000 in big deal, live in it for the 12 months, pay the mortgage for the 12 months, and then sell it. You're still going to be, maybe you give up, but they got to live somewhere anyway, right? So
right. True. Yeah, they do.
Right. So
pretty good investment for 12 months.
Yeah, it's a solid opportunity, to be that.
And you can
close
take
to
your
the GTA.
time, right? And you can take your time between now and 12 months too. Listen, I mean, if rates continue to come down, property values may go up a little bit to make up for for the living there anyway, for the cost of the 10, 11, 12 months that you're living in it. That property may go up by that 20, 25, 30,000 anyway, that offsets what the mortgage payment is.
Thanks, Adam.
Yeah. All right. Thanks, guys.
Thanks.
Clear as mud, huh?
Clear as mud. Clear as mud. There's always gray areas in a lot of things. You just got to be careful. I don't know.
It's not worth taking the chance of having to pay.
I don't think so either.
It's not worth taking the chance, especially like we were saying, like with rates potentially coming down, the market could come back up.
That was my next question to you. What do you think is going to happen with the market if rates come down another?
I think it's going to take. I don't know if it's going to be within the year, but I'd say 2 to 3 years. If they're down, around 4%, high threes.
But you don't think prices are going to start increasing?
Yeah, they will. They will eventually because buyers are going to come
not like
out.
2021.
No, nothing.
Let's
That's
take
not
that out of
happening.
the equation because I hear that once in a while.
No, forget it.
And listen, I get a little disappointed in my industry and yours. I mean, on Wednesday, whole bunch of realtors posting on social media, get off the fence, let's go, it's a quarter point.
Yeah,
but the quarter point doesn't do anything yet. The fixed rates haven't come down. Just the prime rate has come down a quarter point. It's not much different than it was on Tuesday.
And it's not going to save you much. It's not going to save you much a month either.
No, it
right?
doesn't. It's not saving you much a month at all.
$15, $20?
$15 per 100,000.
Yeah,
Nothing.
exactly.
Like not enough for somebody to be sitting on the fence for the sake of if it's a $500,000 they're not sitting on the fence for $75 a month. That's not why they're sitting on the fence. They're sitting on the fence because it's $600-$700, not $75 a month.
But my thinking is now, if you're a buyer, is the time to make your deal.
Yes, it is.
Before things start.
Start to go up again. It's a supply-demand market, right? Right now, we're low on supply, but our demand is pretty low right now too, due to the interest rates. When demand starts to shoot back up, we're still low on inventory. I think we're sitting around 2 months of inventory, which isn't a ton of inventory, especially for a city like this. And it's a Canada-wide issue. We don't have a whole lot of housing. So when that supply is low and the demand kicks up, prices are going to kick up again as well. Like we were saying, it's not going to be like COVID. That's not going to happen. But
it'll never happen again.
No, it won't. Not in our lifetime. But we will see an adjustment, right? When people come out of the woodwork and there's competitive buying scenarios, that's when prices start to come up a little bit. So I have been saying to my buyers, if you're able to afford it, now's the time to get in, and then you can kind of reap what you sow when interest rates come down a bit. But
I would think that's when you'd make your best deal right now.
Yeah,
for the seller.
But it's the people that can afford it. Like you can't go in there and make yourself poor trying to get into the market or any of those types of situations. But if you're an investor and you're able to do this, maybe you're only losing a couple $100 a month for now, and you're able to sustain it. I think it'll be beneficial to you in the next couple of years for sure when interest rates do.
See, I told you like Jonathan's take better than, hey, everybody, you better get going right now.
I know. Jonathan, it may not happen in Steve's lifetime.
You mean in the next
unlikely to happen in mine or Greg's.
In the next 2 years?
It could happen in yours.
All right, I appreciate that.
You're a young guy. Like it could happen in your lifetime. Steve's, it's not going to happen, definitely.
All kidding aside, though, the next if and when the next pandemic hits, they're not going to be as loose with the money as they were this past time.
Well, you hope they learn
look
something.
What happened to the economy.
But different governments then, it'll be... Listen, you think they learn from history, but they don't.
Yeah.
They make the same mistakes every single time. That's what's... It is. It's mind-boggling to see the same mistakes made over and over and over again with no repercussions.
Yeah.
Zero.
And we're talking about listings. They're up over 26% from this time last year, which is good.
Yes, it is good. And again, we don't have the buyers out there to absorb it right now. like if you look back a couple of years, we're sitting at a couple of weeks of inventory.
Yeah.
So no, we're getting up there. We've got about 2 months of inventory right now. And again, it's just because we're not quite able to absorb the listings that are coming on. And there's people that are feeling the pinch of the interest rates. You know, if they were on a variable, they thought that they could ride it out for a little bit. They're finding out maybe they can't, and it's time to put the house on the market. Some investors who got in uber low variable rate, now they're paying a ton of money. They're losing too much money every month, and they're like, "Hey, I can't do this anymore. Let's get this house on the market."
And we're going to see more and more of that in the next year, right?
Yep.
Even if rates do come down another half a.
Yeah, but speaking of what you just said, a key critical point. I've had customers this week call me and say, "Hey, Frank, prime rate came down. Should I lock in?" It's like, no. Ooh. You've gone through the worst period ever.
If you've made it through this period, no.
Now it's time to enjoy the fruits of the labor that are coming to you. And the fruits of labor are that now you're going to start to see the prime rates start to come down and fixed rates come down. If anything, if you learned anything from this now, it's going to be that now we're going to continue to stay in that variable or adjustable rate mortgage for the next 6, 12, 18 months, especially while every single economist is predicting that prime rate's going to continue to come down. Now you get to sit back and watch your interest rate come down and your payments come down as a result of the pain that you suffered over the last 2 years that you weren't expecting and nobody was expecting. Now it's time to go the other way and enjoy it. Stay in the variable, watch your rates come down 4, 5, 6 times a year for the next year, year and a half, 2 years, and then reassess. Yeah. If your mortgage is coming up for maturity in 2025, 2026, then you can reassess. You may actually surprise yourself and go back into a variable despite the fact that you went through pain. Because most people in a variable also enjoyed 2 years of 1.5% mortgages. So
they enjoyed
forgot that part and they're only focusing on what's happening now. But the truth is now we're going to get back. And we're not going to get back to the 1.5. Not in your lifetime anyway, Steve. But,
not in the next
but we
year.
will get back. But we will get back into the 3s probably on a variable, which is then a reasonable interest rate to carry your mortgage.
The other thing to consider is if you go fixed right now and something happens, your penalty is going to be
through the roof.
Enormous.
Yes, it is. Through the roof.
Once rates come down.
Through the roof. But again, Canadians are tempted by the fixed rate because it's the lowest one you can get.
It's only a difference of about a point
now.
A
point and a quarter, but that's a lot. For some people, that's $500 a month, and that's significant enough for them to decide to go with the fix.
Yeah, but if you get out, if rates come
back, you won't get out.
No, you don't get out. You're not. Nobody's
you
paying
are not
penalty.
getting out. If you sign for a fixed rate mortgage today, and a year from now rates are 1.5% lower, and you call and you say, "Hey, can I get out of the mortgage?" The penalty is going to be so high, you're not going to be able to get out. So that's. But again, for some people, they can't sleep at nighttime being in a variable. You got to take the fixed. I would suggest taking a 3-year fix. At least you can get out a little sooner.
Yeah, you better make sure you're really in love.
Yeah, that's right. That's right.
521-TALK, 521-8255. We'll be right back. Welcome back to the show. Jonathan Hall is here for Paul Rushforth. Frank Napolitano is here. Greg's hanging around as always, doing his marvelous video thing.
He's the color guy. You know, in hockey games, he sits on the ice by the glass. That's who Greg is. He's on the ice.
He's the guy with the camera through that little hole in the glass.
Yep, that's it.
Do I get to talk?
Do I get to talk?
What, are you married?
Not anymore.
So our months of inventory now 2.3 as opposed to last year 1.3.
Yeah,
so we had fewer listings last year too, right?
Yes, we did. And again, that's just we're not absorbing anything right now. You know, if 10 listings, just use an arbitrary number. If 10 listings are hitting the month, there's only 3 of them that are getting absorbed, and you're going to start to build those listing numbers up.
But 2.3 doesn't seem that bad to me, isn't it?
No, it's still pretty low.
Isn't the average usually about 3 or 4?
Yeah, the average is about 3 or 4. I know when I first got started in 2013. God, I think we're around 6.5 months of inventory. Especially the condo market downtown was really saturated.
Ooh,
as well.
That was hurting.
It was a tough time then. So no, 2 months is still a seller's market. We're kind of bordering right into a balanced market around the 3-month mark, but it's a good amount of inventory. It's giving people some choice out there. It's a little bit easier for buyers to go out there and do a little bit of negotiation, buy with conditions, all of the things that a traditional market usually has going on for it.
Are sellers more confident now that the rates have started to come down? Do they think that they're going to get?
Oh, that's what I haven't been able to gauge that. It's been too fresh.
Come on, it's been 3 days for goodness' sake.
It's been too fresh, but no, I don't. And you know what? I tell them the same thing. I'd say it's a quarter point. We're not gonna see people beating down the door like we did a couple of years ago. It instills some confidence in the market. But that's really all it's doing right now. It's just instilling a bit of confidence in the market for the buyers to go out there and make sure that they're making the right decision moving forward.
I bet they're going to start looking, though.
Yeah, you bet.
Maybe not, close the deal in the next month or two, but I think
they're going to start to get out there.
The interest is back now.
Yeah, the interest is back out there. I know, like we've been talking about, there's been just a ton of interest about interest rates for the last year or so, anyways, right?
Since July last year.
Yeah, and we've been teased with a rate cut for so long, so it's finally happened now. I think some people are going to start to come out of the woodwork, like you said, start kicking tires a little bit. But again, I think it's going to be pretty much status quo from what we've seen for the last couple of months anyways.
Now, sellers' expectations.
Sellers' expectations.
We're pretty flat, right, from last year to this year?
Yeah, we're pretty flat, and I'm carrying 5 or 6 listings right now, and it's just about managing their expectations. We're sitting around 32, 33 days, average days on market, depending on price point and location.
But that's my question, price point. What are sellers' expectations now? Do they look back 2 years ago and expect to get the money that their neighbor got, or are they more realistic?
And that's up to your real estate agent. They've got to let you know that that's not attainable anymore. You've got some people that are still shooting for the moon, but
that listing will sit forever.
It will. It'll sit forever. Buyers are too smart. Buyers are too savvy. It'll sit forever. You've got to price the property to what the current market is. So no, it's about if I have a seller in there and there's they want 1.2 million, and I'm saying no, it's worth $999.
Yeah.
I'm not listing the property because it's just going to sit there.
Yeah.
There's no.
You're not doing them any favors.
You're not doing them any favors. And you're doing.
And you know what? Some other agent will come in and go, "I'll do 1.3 for you just to get the listing."
Get the listing, get the phone.
But you don't want that agent.
No, you don't want that agent. And all it does is put a stigma against your property, and at the end, you're going to end up losing money on it, right?
And once it sits, people see that, right?
Yeah. People know. Like, there's too much information out there. Like, with the internet, buyers, like I said, they can gather any information that they want. You see a property sitting there for 130, 140 days. It's price, it's condition, or it's location. So if the house looks good and it's in a good location, well, it's the price.
Yeah. Where's the movement now? Is it more or less people moving up to a bigger home?
Yeah. Yeah, we're seeing, like, people moving from their, somebody who bought a townhome in 2018 for $350,000.
Yeah.
And they're selling it now for $650 or $700. They're taking that equity, moving up into a bigger home. Most of the time, their family may have grown a little bit as well. Those are the moves that we're seeing. And then we're seeing the first-time home buyers. They're kind of sitting right around the 550 and under. They like to stay 5 and under. Condo. I would say. Yeah. They're looking at condo townhomes, that type of thing.
They want to keep their payments close to their rent.
Exactly. You got it. That's bang on, Frank.
Yeah.
And it's the market starts to slow down a bit as you get into the 850 and above. That's where we've started to notice a little bit of a slowdown. People haven't gained as much equity in order to transfer that over into that move. That market's a little bit slower, but it's always been like that here in Ottawa. Over $1 million was always it was always a little bit slower here in Ottawa.
But $1 million isn't what it used to be.
No, it's not what it used to be. Now, and over $1 million during COVID was rocking and popping.
Yeah.
But we started to notice a slowdown at the upper echelons for sure.
I think you're going to see people now trying to move up. Don't you, Frank?
I think
knowing that the rates are on their way down.
We're not there yet.
No, but knowing they're on their way down.
Agreed.
If you want to move up, your payments are only going to go down.
Yep. Two types of customers right now or buyers are sitting on the fence. Number one is the first-time home buyers. They're sitting on the fence. You've got the people that are in houses that want to go to the next level, but they got to be able to sell their house, and they don't have as many people buying them. The other part that's sitting on the fence that's basically gone away are investors, people that are buying those investment properties, their townhouses. With the cash flow, with the interest rates where they are, their cash flow is $500, $600, $700 underwater, so they're not moving forward. But as interest rates come down, and if they can get back into neutral cash flow, then all of a sudden we're going to start to see a whole bunch of people investors buy some homes so that they're available for rent as well.
How much is going to have to come down before that happens?
A point and a half, probably at least, and we need some amendments to the stress test.
The stress test is killer right now.
It's damaging. So it did its job during the low interest rate, and that's what it was meant to be. Where it's not meant to be is when interest rates have elevated the way they are. This is where I think they need to be a little more proactive. Now, their fear is that the housing market's going to be a runaway train like it was in 2021, 2022. I totally disagree. What the stress test is doing today, people that qualify on the traditional lending are having to go to the alternate lending because the stress test is unable to make them qualify for the traditional lending, especially if they want to do what's right, which is you've got a mortgage coming up for maturity, you've built up a whole bunch of equity, but you've got some credit card debt, you've got some loans that you want to put all in one because the interest rates are up and you want to get your cash flow in line. And the problem is that once we had the stress test, all of a sudden they don't qualify for A and they got to go into a B lender. Well, you're hurting Canadians. You're supposed to be helping Canadians. Instead, you're hurting Canadians. That's the change that has to be made.
And it's taken away choice between variable and fixed.
It really has. Mm-hmm. In so many cases, it has. And now you're forced to take something that you're going to regret just a short 6-12 months from now.
Yeah, because if you got to lock in, and you don't, like I said, you don't want to lock into 1, 2, or 3 because you're paying crazy amount.
Yep. Yeah, you're better off taking a variable. But you can't lock into a 1, 2, or 3. They're forced to take a 5-year because it's the only one they qualify for.
Exactly. Yeah, it's the only one that they're going to qualify for.
That's the only one they're going to qualify for. So they're forced to take it.
It doesn't seem right.
Doesn't seem right.
That's what I mean. That's why you got to change this, Frank.
That's why I'm saying they just need to be more proactive. They just forward thinking as opposed to just sitting on their, you know what, and just saying, let's see what happens. Let's see what happens. No, be a little bit more forward thinking and help Canadians. Help them stay in traditional lending, which is much better for them than alternate lending.
Yeah. Well put. Birthdays?
Trying to help. Yeah, I've got Christine Earl from my office celebrating her birthday. I was blessed and very happy to be at my niece's wedding last night. So Vanessa and Spencer, congratulations. Great wedding. Boy, coupled together from high school, 11 years, like they were meant for each other. It's so heartwarming to see. And then last but not least, I want to put out a shout-out to our friend Nash. Adam Cote, mortgage broker, competitor, but still a friend. Again, the way our industries work, right?
Yep.
As much as we could be competitors, we're all going to support each other. Nash, who happens to be the son of Adam Cote and Angie Poirier, who was with Bell Media for the longest time, undergoing some cancer treatments. And Maverick Donuts, he designed a special donut at Maverick this weekend. If you go to Maverick Donuts and you get the Nash donut, they're going to give $3 for every donut sold to help support
Fantastic.
Nash and his treatment. So if you get a chance, if you can go by, again, great local company, Maverick Donuts, and pick up some Nash donuts, $3 from everyone, and it'll help Adam and Angie with the very expensive treatments that they've got on their go.
Fantastic.
And Nash, you keep getting better.
Jonathan, how do we get a hold of you?
Well, Jonathan at paulrushforth.com. Or you know what? I've got a cell phone. It works.
Does it work?
All the time. Works all the time. 613-915-0740.
Are you in a relationship right now? Not to be too personal.
Yes. Yeah.
So how does that go over when you get all these calls?
It's okay. It's okay. She understands. She understands what the nature of the job is. So no, it's quite all right when these calls start rolling in.
That helps. That helps
great.
the relationship.
And do you answer them no matter what you're doing?
Well, unless I'm playing goalie, unless I'm on the ice.
You don't have it there?
No, it's the only time. That's it. Even if I'm on the golf course, I'll answer it. I'll take a couple of holes off and walk up the fairway and take a call. I'll answer it any time.
Well, I'm thinking playing goalie isn't the only time he's not answering. But anyway,
well, that was my question to begin with. Have a great week, everybody.
Support local business and charities, everyone.